All right, so there you have it. Reserve Bank Governor Lesetja Kganyago, they're keeping rates steady at 7%. That's the repo rate. Your prime lending rate at banks, of course, would mean will remain at 10.5%. Let's try and tear out this MPC statement and see what it really means. With me, Kevin Lings from STANLIB, Chief Economist. Thanks indeed for joining us.
Pleasure.
Viv Govender from Rand Swiss. Thanks, gentlemen, for coming in. Let's start with the tone of the statement, Kevin. I mean, a bit more subdued than the last one. This is by no means any hawkish stance. What do you make of it?
I think it's not a hawkish statement. If anything, perhaps a little bit more dovish. I think there's an acknowledgement that the economy is a lot weaker than what it was just literally a couple of months ago. They revised down their growth number. And at the same time, they seem a little bit more optimistic on the outlook for inflation. They haven't adjusted their inflation forecast all that much. But clearly the latest numbers surprised significantly on the downside, and there has to be the prospect that in months to come inflation could move lower. And then there's a clear option to cut interest rates. So I would say this sets us up for the possibility of an interest rate cut before the end of this year.
Viv Govender, do you see it that way as well?
Yes, most certainly. Basically, the danger of inflation has been moderated. I mean, not to know basically work of our own. It was the rain came through, the drought has ended, food prices came down. That helped with regards to inflation. The growth rate in the country is quite low, has been downgraded. There are basically some risks as well to the rand, but I mean, if you just have to look at the normal factors that go into it, the inflation rate and the growth rate, it should advocate for a cut coming through sometime soon.
I think the downward revision to his growth numbers are meaningful. He's still got growth rate this year at around 1% and still improving over the next 2 years.
Seems like a fraction though, 0.2%. Does it make a difference?
It does. The whole tone, if you look at it now over a period of time, we've clearly had to pull back on these expectations. It wasn't that long ago that we thought growth would be back over 2%. And remember that when we looked at our fiscal numbers, the government's budget, tax revenue, all of that presumed growth back over 2%. So I think that we've systematically had to give up on those growth expectations. And that ultimately has to feed into a view that says inflationary pressure remains subdued over a longer term period, not just in the immediate 1 or 2 months.
And of course, to get that growth, you need economic activity, which he says is not anywhere close to picking up if you look at consumer and business confidence.
Yeah, and the things that are coming through with regards to the downgrade are going to make it more difficult. He's talking about the fact that the public sector, or the private sector rather, has, there's been talk in other speeches by other people from government about an investment strike effectively in terms of capital expenditure. And now he's talking about the fact that the government's going to find it more difficult to raise capital to do the kind of spending that it wants to do in order to take out some of the slack from the private sector, and that's also going to be due to the downgrades. And he even mentioned the fact that should we have more of the worst case scenario with regards to the downgrades come through, we could see quite a large outflow of funds being forced on current bondholders, especially among those funds that have rules about just the level of grading that a bond issuer has to have in order for them to hold those funds. So that's obviously a danger. But speaking of growth, I mean, the pattern for the last 5 or 6 years has always been next year it will be better, and the year after better, and the year after the better. It's always being downgraded as we ever get closer to that actual date.
I want to tackle the rand when we come back. We've got to go to an ad break, but please just stay with us. And when we come back, we'll tackle the rand and more on that growth as far as the MPC statement is concerned. Stay with us.
To be African is beautiful. To be African is a privilege.
It represents hard work. It represents being able to stand on your own.
And respecting other cultures as well.
It's about promoting African heritage.
We are all Africans. Let's come together so that we can have a formidable force.
Our cultures interlink with one another.
And by standing together and embracing one another, there's power in unity.
It is time to cut off this issue of xenophobia.
I stand for African unity. I stand for promoting unity in Africa because
there are many opportunities
to be whatever you want to be.
Africa is one of the most important continents.
Because if we can come together as one, we will be able to actually build a better Africa, the new Africa for the future.
And if we unite our hearts and our minds together and we go forward, we will conquer.
So let us all arise and be proudly African.
Being an African is who I am right now.
I'm proudly African. I love Africa.
Wishing you all a very happy Africa Month.
One love.
Welcome back. With me, Viv Govender from Rand Swiss and Kevin Lings from STANLIB, talking about that MPC monetary policy statement, the repo rate staying at 7% as announced by the Reserve Bank Governor. Let's get into it. I want to start with his words, the Governor's words, Kevin. A reduction in rates is possible if the inflation trajectory goes the way it is going at the moment now. What do you make of what he's saying? Can we get rates cut soon?
I think that's what he's setting us up for, is that he is saying in the same statement that the inflation forecast doesn't take into account the most recent inflation number. Remember, they adjust their forecast periodically, typically once a quarter. And so you're likely to see another big adjustment to the inflation outlook to the downside next month. If there is, and assuming that the growth rates are still weak, assuming the rand is relatively stable, that would argue the Reserve Bank is then either going to cut interest rates at the next MPC meeting or signal clearly that a rate cut is then imminent.
So much of that, Viv, depends on the resilience of the rand, which has been resilient even after the cabinet reshuffle. But he mentioned two important factors there, the attitude towards emerging markets and then those downgrades. What do you make of it?
Yeah, look, I mean, the emerging market story of the last year or so has been a lot more attractive than it was, previous. We saw commodity prices recover quite strongly. Look, Africa, which is basically the emerging market we deal with mostly, has still growing, or is still forecast to grow slower than the global growth rate this year, which is obviously a negative. But it is a sign that things that are covering places like Nigeria, etc., seem to be avoiding recession. That being said, but a lot of that's dependent on the commodity price cycle that seems to have bounced back a little bit. And now we're seeing some weakness coming through with some of the stuff with regards to iron ore prices, like you mentioned, falling quite dramatically from the earlier highs, so early in the year. But I think the main thing in South Africa is the fact that the political situation is so fluid. We have no idea what's happening on a week-to-week basis. You've got to check Twitter before you go on an interview just to see if there's any new development happening out there. Because some things are happening with such speed. I mean, just right now, I've seen like reports out there that apparently one of the reasons the currency is looking stronger is because there's discussions around the presidency at the highest level at the ANC because of the recent situation with ESCOM, as well as some of the elections that have come through. And if that does occur, and we do see some change happening at the top, history has said that anything negative for the presidency has been very positive for the currency, and we could see a massive spike up in the currency. That being said, if this kind of news goes away, we could see the reverse happening as well. So
I think what he's doing is he's warning us that yes, inflation could surprise on the downside the next time we get the forecast, but we've got to realize that if the political backdrop deteriorates, if there's more volatility in the currency markets, let's say foreigners are taking money out of South Africa, then clearly rates are still going to remain on hold. So I think he's given himself a out in terms of the rate outlook. On assuming everything stays where it is, you would forecast a rate cut. But he's got this issue on the side which is related to politics, related to foreign investment. If that deteriorates, if there's a further credit rating downgrade, then yes, interest rates remain on hold, then judging how we evolve from there. So I think it's not necessarily a bad position to be in. It's clear that we're not going to hike interest rates. And if we'd said a couple of months ago that we're going to have a credit rating downgrade, what would the Reserve Bank do? We would have been worried back then that we would get a hike in rates. So at least that's not a debate. We are debating rates unchanged or possibly a cut.
I wanted to go back to growth. There are people out there that are saying, well, give us a little bit of loosening, give us some space and let's get the economy growing. But Kevin, I remember you've said this time and time again, one can't rely on the Reserve Bank for that growth, because that growth that the Reserve Bank can give you is not enough to create the jobs, is it?
That's right. Particularly, let's say we cut interest rates. How much would we cut? 0.25%, 25 basis points. Let's say we even cut rates twice. That's 0.5%. Yep. How much stimulus would 0.5% do to the South African economy under current circumstances? You'd have to argue fairly modest. If we look at what's holding back this economy, it's not interest rates. You can't say interest rates are the key damaging factor to the South African economy. What's holding us back relates much more to confidence, business confidence, a lack of business investment, and that in turn relates to the political environment. It relates to the credit ratings. It relates to some extent to policy uncertainty. So if we want to lift growth, we've got to deal with the political backdrop, with the concern of the rating agencies, and we've got to lift confidence within the business and the consumer sector. Interest rates will help a little bit, no doubt. They help to relieve some of the pressure. Consumers are under significant pressure, so cutting rates does provide some benefit. But we're not going to cut interest rates and then say, oh, look, growth is now 2%, 2.5%. It won't have that beneficial effect. So there's very little, ultimately, the Reserve Bank can do to really stimulate the economy. What they're trying to judge is, can they provide some modest relief versus do they perhaps put us at risk having cut rates, that the rand then starts to weaken, that foreigners take money out because interest rates are lower. They're judging those types of parameters. But I stress it's at the margin. The big growth initiatives have to come directly from government.
And Viv, I guess the big part of that equation would be structural reform within that policy.
Yeah, look, I mean, in economics, there's always been the term that, fiscal policy is a stick. You can actually push the economy forward with fiscal policy, but monetary policy is more of a string. It's much more useful to pull back growth when growth gets out of control, which we haven't seen in a long time in South Africa. So if you do lose monetary policy, all you're doing is just taking away some of the restrictions that monetary policy provides, but if there's no actual push for growth from other sectors in the economy, there's no demand for investment, there's no demand from consumers, etc., coming through, the economy will not take up. Structural reform, I think to a certain extent, is something that we have to do in this country. Looking at our economic base where we are right now and where we potentially could be, looking at what things or countries like China and some East Asian countries have done, growth rates of 8-9% are possible from a base like where we are in South Africa if things were right structurally. But to get to the output gap, where we are right now, to the output gap, which is like a few percentage points better than where we are right now. Yeah. What we really need to do is basically do the short-term stuff with regards to confidence, with regards to policy certainty, etc., etc. And that'll get us to a point where we're a couple percentage points higher than we are right now, to do the kind of growth that we potentially could have, the structural reforms that you're saying, that's changing the capacity of the economy, infrastructure, education, all those kind of things. Those are the things that can get us to the miracle growth rates we've seen in places like India and China, etc. But that's a much, much longer thing that takes many, many years, even if not decades.
Kevin, what do you make of this number 5 voting for unchanged rates, 1 putting forward a case for a reduction? We've seen that in the previous meeting.
We saw it in the previous meeting. So clearly that's again telling you the bias is towards a discussion of an interest rate cut. Clearly there's one person who feels, I would suggest, that the economy is so weak that we've got to do something to provide relief. And there is an argument around that. And as we know, inflation is now inside the target range. And again, there you could argue that we've got inflation low, the economy is weak, let's provide some relief. I think where the overall MPC would disagree with that one individual is that you've got to look at what is the global backdrop. Yeah. And the global backdrop says to us, be a little bit cautious. The credit rating backdrop says be a bit cautious. Don't necessarily cut rates without clear evidence that inflation is perhaps in the 4.5% range.
Mm-hmm. Viv, the two big players internationally, let's talk about what's happening in the US. Let's talk about China. He's mentioned what's happening as far as Chinese economic activity is concerned. How important are these two players when considering what's happening here this afternoon?
Okay, but the US is still the world's largest economy, or second largest, depending on how you measure it, but it has a huge impact on the global economy. And some of the stuff that we've been seeing that we were hoping to come through from Donald Trump, not as a political or moral or ethical situation, but as business people looking at the market and that kind of stuff. We were looking at reform of the tax system, which was something that would have been a huge positive for the US economy as well as for the globe as well in a roundabout way. We were looking at some kind of reform of some of the corporate regulations that they had there that would have been positive for growth, at least in the short to medium term, something like some of the regulations around what's happening with the banking sector, etc. And those things, I think, right now are on the back burner. I mean, almost every discussion you see from any US commentator at the moment is about a possible impeachment of Donald Trump. I mean, the odds of it right now from, analysts, but I mean, they've gotten it wrong, many, many times in the past, are something like 50% he won't finish off his first term, which is an incredibly high number, So that's obviously some uncertainty happening in the US at the moment. China is right now has been downgraded by Moody's. Look, the Chinese economy, it has grown really fast and has done like incredible growth rates. But I could tell you one thing that's what bad about China. If you had to look at India, for instance, a comparable economy, not growing as fast, but has taken over recently from China, especially in things like foreign direct investment. 50 years from now, what's going to be the Indian political system, the current political system, a democracy with the same kind of thing that it's doing right now. 50 years from now, what's going to be the Chinese political system? I have no idea. It's very unstable in that part. You don't know exactly what the reforms are going to be, how things are going to turn out going forward. And the stuff in China right now is really hitting at the kind of capacity that we have seen in the past in places like Russia, in places in the Eastern European countries when they're still under communism, where you can accomplish a lot at the start of an economic upturn of development by having a communist or centrally controlled system. But when you really want to do the step up from where you are right now to the first world level, you need to have more freedom for the population, which may be something China may not be able to do with the current system.
What does that international scene mean for us, Kevin?
Look, at the moment, it's not too problematic. In other words, if the world economy does better, it tends to lift South Africa. If we look at world growth, the expectation is that in total, world growth does improve a little bit over the next 2 years. That would have a tendency to lift the South African economy a bit. So I think the backdrop is, on balance, helpful. Plus the fact that when you look internationally, there's not a lot of inflationary pressure. That would suggest equally we shouldn't have a lot of inflationary pressure ourselves. So I think that's supportive generally of fairly low interest rates. I think the Reserve Bank would look at that, but then realize that South Africa is a vulnerable emerging market, and that we can't simply assume and rely that foreign investment's going to keep coming into this country. And therefore, if we don't get growth up, if we don't stabilize the politics, then he's going to be forced to keep interest rates where they are in order to limit our vulnerability to changes in international capital flows. So it's actually quite a tricky position for them to be in.
Okay, so the governor has flagged downgrades. We'll try and talk about that when we get back. More coming up after the break.
Have we taken enough responsibility for our responsibilities with regards to freedom?
Largely the moment of 1994, that moment of absolute magic. Firstly, the voting, and of course when we watched Nelson Mandela take that oath of office, was a moment that we thought, well, we've now reached freedom. This is it. This is all that it can be.
Off with the big story of the day, where Eugenie Bouchard beat Maria Sharapova for the first time. Bouchard upped the ante and closed off the 3-hour epic grudge match with a rousing performance to win the most highly anticipated match so far in this year's clay season. Final score 7-5, 2-6, 6-4. Title chasers Cape Town City FC travels to Pretoria, intent on grabbing 3 points from a resurgent SuperSport United.
Get all the dominating stories locally and globally on Newsroom every Monday to Friday from 9 a.m.
Welcome back. More analysis now on the latest MPC statement from the Reserve Bank. Reserve Bank Governor Lesetja Kganyago holding rates steady at 7%, which means your prime lending rate of the banks remains at 10.5%. To make sense of the latest statement, Viv Govender from Rand Swiss and Kevin Lings, chief economist at STANLIB. Gentlemen, once again, thanks for joining us. Let's just look at this downgrade. He's flagged the downgrade word more than once in this statement. And I guess the concern here, Kevin, is if we have a downgrade to our local currency and you have this mass outflow of the rand, that's going to hit the country quite badly.
That would be quite severe. So we're assuming therefore more downgrades than what we've got at the moment. Obviously, we're still waiting for Moody's to give us their update. I suspect they will downgrade us, but keep us on investment grade. So I think what the governor is referring to is if the fiscal situation deteriorates from here further, if the political backdrop is messy, there's just no pickup in economic growth, his forecast for 1.7% growth next year doesn't materialize, then we have to accept there's a risk that we get further downgrades from the rating agencies either later this year or during the course of next year. If that happens, there's a risk that those ratings push us out of various investment indices, global investment indices, particularly the global bond index, and as a result, foreigners could then be forced to withdraw money from South Africa. That would be quite severe. We would see the currency weaken, we would see inflation go up, and we would see, importantly, confidence deteriorate. Now, the governor flagged confidence as a key factor in how we lift growth in South Africa. So he's just warning that while we've been downgraded, we can't assume that that's it, that we've been downgraded and that there's no further downgrades possible.
Or consequences.
We can go further. We've got to stabilize this economy, and importantly, we've got to get a way to lift the growth rate. Now, at the start of the show, we were discussing that we're constantly revising down growth estimates, and that's a worry for the rating agencies. Every year we forecast, gee, growth is going to get better. Then when we get there, we say, no, 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 it hasn't got better. Ultimately, we're going to get downgraded if we can't get the growth rate up. And by that I mean get our growth rate above 2%.
And Viv, it's happened again. I mean, last MPC we had 1.2%. We're now back to 1%. I want to get back to this bond indice thing that Kevin had brought up. If our local debt is downgraded one more time, I mean, there we slip out of those bond indices. And I guess many people don't understand that investors are then compelled to take out their money out of the country. That's when you could see that slide.
Yeah, what's been protecting us thus far is I think the foreign investors kind of don't have the same, quite as negative outlook on us as maybe some in South Africa do have. And that's one of the reasons, for instance, the currency being relatively strong. He mentioned the fact we saw the currency remain quite strong, much stronger than it was in the period when the Nenegate happened effectively. You know, we saw much more of a blowout. Then this time around, there was a bit of a blowout, but I mean, because of the fact that the currency was at historically strong levels on the morning of the announcement of the callback, you know, and we did weaken from there, but compared to where it was the week before, we really haven't weakened that much from where the currency was the week before the callback for Pravin Gordhan occurred. But if it does happen like this and these investors are forced to take their money out of South Africa, these bond investors internationally, these fund managers, they are searching the world for yield. And right now in South Africa, we're getting some more yield than you'd get basically in other parts of the world. I have clients that have money in the UK, for instance, they're getting basically for you know, hundreds of thousands of pounds, a couple of pounds a month in terms of return because of the very low interest available in other parts of the world. In South Africa, you're getting a 7-8%. You know, those kind of are very attractive to international investors who are searching for yield somewhere in the world. But if they are forced to do something, they have no choice because it's built into the constitutions of their funds, and they have to get out of things. And then in that case, we would see these forced selling situations occurring.
Yeah, so we would need, once this money starts to leave, let's say that these investors, by their own rules, remember they set the rules, not us setting the rules, by their own rules they'd be forced to sell. We estimate that would amount to around about 100 billion rand out of our bond market. That's fairly significant. So let's say that foreigners now liquidating 100 billion, that would normally put our currency under pressure. What we would have to hope is that there are other investors who are not bound by those rules, who say, well, I like this investment, I'll come back into South Africa and I'll take up some of that investment. That's a risky thing to bet on, because obviously at that point there would be a general move away from South Africa and a loss of confidence. So we don't want to go there. We don't want to test just how resilient foreigners are regarding South Africa's investment. I think we've done remarkably well, given that our credit rating has moved down appreciably. But that we've got to recognize that a further decline in ratings, we could see a lot more money at risk, and it may not be as good an outcome after that round. So the answer is don't go there. Don't get a further downgrade. Make sure government finances are well managed. Make sure the growth rate is improving. Make sure there's more confidence coming back into South Africa. And then we won't be forced in that direction. And I suspect the Reserve Bank will have scope then to cut rates. So it's critical at this stage that we get this economy moving in the right direction.
Viv, how well have we done on that from the last downgrade we received on fixing things up and possibly changing a decision on a downgrade?
Nothing at all. quite frankly, I mean, if you look at the biggest danger right now, just the most obvious thing, Brian Molefe at Eskom, okay? Eskom, the nuclear power thing, according to some estimates, would put something like 20,000 rands of additional debt for every man, woman and child in this country into the fiscus. That's a huge amount of additional debt. And the fact of the matter is that this amount of Eskom's spending possibility around the nuclear deal would be enough to basically get us into some real trouble with regards to repayments. And the problem with this particular kind of situation is that we might get into a negative feedback loop in which basically higher interest rates cause the government to be less able to pay back its debt, which cause even higher interest rates, and et cetera, et cetera. We want a positive feedback loop in which the interest rates fall, making it easier to service the debt, giving more flexibility to the government to spend more money to increase growth, raise more taxes, and all those kind of things. And the problem at the moment is that there's been good signs. There's been rumors around about reform happening, about changes happening at the upper echelons of the ANC, etc. That may be in terms of stance, in terms of outlook, etc. And we've seen that, for instance, with the Brian Molefe situation, where the ANC acted almost as opposition party to the move. And that, I think, is very heartening to overseas and local investors. But should there be no actual change, should we have a continuation of what's happening right now, and these positive buzz not have any fruition, we would see a big negative downturn. And in reality, we haven't actually seen any concrete moves done by the government to make things better. All that's been done is moves by opposition parties, by moves within the ANC to try and affect government's choices.
I want to end off with you, Kevin. During the break, we were speaking about this phenomenon as to how a rain or drops of rain can actually be connected to your home loan. I mean, if it's not there, inflation goes up, interest rates goes up, and you end up paying more on the home loan.
It's hugely critical. It's the single biggest factor right now in South Africa's inflation outlook. So remember, last year we had a drought. Then we went into a very good agricultural season. And this year we're expecting the maize crop to be 87% bigger than last year. That's huge. And all of that because it rained. And because there's more rain and better agricultural production, food inflation goes from double-digit inflation into single-digit and lower. As food inflation comes down, the whole inflation rate comes down, and Lesetja puts himself in a position where he could possibly cut interest rates. Now, what about next season? If we don't get follow-up rains and we start the next summer season and we don't have the rains, then the opposite starts to happen, right? We end up, we've got a drought. Food prices go back up because there's an agricultural shortage. That pushes inflation up, and the governor of the Reserve Bank has to respond then by saying, sorry guys, I may have to put up interest rates. So the rainfall, as weird as it sounds, has a huge impact on what our outlook is for interest rates. At the moment, it's helping us. It's critical that next season we have another reasonable rainfall.
Gentlemen, thanks very much indeed. Viv Govender from Rand Swiss, Kevin Lings from STANLIB, thanks indeed for your time.
Pleasure.
And that's where we leave it. Your repo rate now at 7% left steady, which means that your prime lending rate at the bank still 10.5%. That's it for the special broadcast.